Hello, and welcome to Fund in Focus, ARK Invest series, where we speak about a specific ARK Invest fund and answer some common financial advisor questions about that fund. I'm Brett Winton, ARK's Chief Futurist, and with us today we have Tom Staudt.
Thank you, Brett. And today we're going to cover ARK Innovation ETF, ARKK, probably the most well-known of the ARK funds. And I certainly encourage anybody watching to go through our video series here to hear about each of the individual themes and funds we have more in depth, because ARKK really pulls from each of those funds. But maybe let's just start there. Innovation ETF. What is an innovation ETF?
Well, we think we're at a unique time in technological economic history. We think there are 5 major innovation platforms entering the economic marketplace at the same time and hitting critical stages of inflection. So those are robotics, energy storage, multi-omic sequencing, public blockchain, and of course, artificial intelligence. And we think that artificial intelligence is catalyzing and accelerating all of those technologies. And so the ARK Innovation ETF provides a balanced exposure across all of those technology platforms. And we think over the course of the business cycle will provide meaningful capital appreciation based upon our expectations for how those technologies will perform.
Now, we've heard certainly the term innovation thrown around by some other fund companies more and more in the last 4 or 5 years. And certainly the NASDAQ index positions itself as the innovation index. How does an innovation ETF, how does ARKK differ? How should an advisor think about it differently than the NASDAQ?
Sure. Well, one, the technologies we focus on are really disruptive technologies. They all follow steep cost declines, they all cut across sectors, and they're all platforms on top of which other innovations can be built. That actually, often wrong foots incumbent providers, including in the technology space. So if you look at the NASDAQ, everybody knows these large cap tech names that are mostly what the NASDAQ is composed of. So take Google. Google has an amazing search business, and hey, they've started paying out a dividend. That's great. That's a clear sign of a technology company. But Google has been consistently behind in AI. I can say that subjectively, but also objectively. If you look at kind of the cost of Google's AI APIs, their AI services, they cost on average 40+% more than what OpenAI and Anthropic have offered over time, adjusted for performance. So here's a company that has all of the talent in the world, all of the money in the world, and they're consistently behind. Why? It's because the technology is disruptive. And that means that Google's future state is, in question to some degree, at the same time that Google and Apple also similarly challenged in terms of its ability to deliver on anything meaningful AI related, at least thus far. And even Microsoft, which has a lot of AI exposure, but is in a strange relationship with OpenAI and kind of is trying to package those services into its Office suite, but not in a very efficient way. Those are all at incredibly high valuations today. If you take a NASDAQ exposure, you're taking exposure to companies that are, yes, technology incumbents, may be disrupted, maybe they'll do okay, but extremely richly valued. Meanwhile, the disruptive innovation companies that we're invested in are, one, more likely to enjoy the technological tailwinds rather than be disrupted by them, and at relative to their history, extreme valuation discounts. And so kind of like the way I think about the NASDAQ exposure is, one, everybody already has that exposure in their core portfolio indices, and it's not a true disruptive technology exposure. So in case we happen to be right about the rates of appreciation that we expect across these technologies, then you actually should have disruptive innovation exposure to protect yourself against the valuation risk you're taking on those mega cap tech stocks in the NASDAQ itself.
I mean, certainly when you think about, you mentioned valuations a couple of times there, and I think it's interesting. You're right, on a PE basis, certainly relative to any historical time period, and the fund's about a decade, at this point, and certainly longer as a strategy. these are almost all-time lows from that standpoint. But even on a price-to-book basis compared to just a broad technology index or even a growth index, it's actually cheaper. And so, with that being said, we've clearly seen headwinds for the valuations of true innovation for the last few years. What has the market been looking at, and what's really the catalyst that breaks innovation out to kind of get, even if they only go back to their old multiples, there's clear appreciation for advisors to allocate now, investors to get that exposure, at this point in time?
Yeah, so clearly innovation exposed companies have been hurt by the interest rate cycle. And it can happen in a number of different ways. The multi-omics companies, often their business models depend upon, continuing to raise capital from the public equity markets in order to get, precision therapies and real cures for disease into the marketplace. And so if you have a higher interest rate environment, which causes kind of people to be less sanguine about kind of the capital markets, then that has a real kind of reflexive action on these companies' ability to operate. And it's true across the tech space. Often companies that we're invested in have great gross margins, and they're investing in building out a platform that then ultimately they'll yield a lot of cash flow off of. And investors have been seeking, cash flow safety. I mentioned that Google's paying out a dividend, as is Apple, right? And Apple, by the way, is at the highest price to sales, or at least as of this recording, nearly the highest price to sales that it has ever been at in its history. So, think about the premium that people are paying for that big balance sheet, and then how that dynamic will shift if there's any kind of real marginal change in the interest rate environment. Suddenly, what are you paying for all of that cash for on aging Colossus that's just released a headset that nobody's bought and is late to AI, when you could be investing in companies that are actually, surfing the technological wave that we see coming?
One of the questions we get from advisors is, well, have those valuations on a relative and overall basis, have those come in because these companies are running out of cash? You referenced cash and paying for the balance sheet. Is it because the companies in ARKK don't have cash?
No, that's simply not true. There's across all of our positions, we do 5-year price targeting, and we also do downside cases. And so evaluate the cash needs of the business and kind of the burn rates and need to raise cash over the time. For the most part, these companies are actually flush with cash. And for those that do have business models that depend upon them coming back to the market, we evaluate kind of the cash needs of those businesses, usually within the multi-omics space. And they have a lot of strategic optionality to kind of do partnerships with large cap pharma, which have very strong balance sheets, in order to get to market non-dilutively. Ultimately, you ask, what will cause kind of the marginal shift of investor dollars into this space?
Yeah.
Well, the interest rate cycle is one thing, but also these technologies are beginning to yield actual performance results. So even if you essentially try to starve these companies of cash on the capital market side, ultimately our theses, we believe, are going to play out, and it will become obvious how valuable these platforms are. So take Tesla, famously, if they were just an EV business, it would be much harder to underwrite than if you had expectations that robo-taxis would be commercially deliverable on the vehicles that they've sold. And we think that given the rate pace of advance in AI, a robo-taxi capability is inevitable on a Tesla. I use full self-driving every day I'm in Los Angeles, and it's amazing and magical. And not only is it magical today, the rate of improvement is astounding. Their business model transforms if they can deliver a robo-taxi service, and that will result in should result in extraordinarily obvious top-line growth in cash flow that Wall Street can't ignore. Another example, CRISPR Therapeutics has delivered what seems to be an effective cure for sickle cell disease. That cure is coming to market this year. In fact, they are just beginning to dose patients for the first time. This is a cure for a disease, and it avoids literally $2 million worth of treatment to the patients that get it. So they're able to charge $2 million for the treatment and deliver these patients normal lifespans and a healthy life. Wall Street's never really seen this before, so they don't know how to underwrite the commercialization curve of these cures. But it's going to happen over the next year and a half. They're going to begin to see this is what this commercialization looks like, whereas they don't have an example of it. And so regardless of the interest rate environment, some of these technologies are going to begin to demonstrate, financial sense that we've been forecasting, but people have been able to say, well, I'm not going to believe it until I see it. And it's going to flow through to some of the financial statements in a way that it becomes unignorable. And what's interesting about that is if and as that begins to occur, then it will cause people to also kind of evaluate their exposure to these positions. It could result in a re-rating across a number of different technologies as the leading frontier players begin to come to market and show the real cash flow characteristics that these technologies can deliver.
So, it sounds like you're saying there's the call option on the duration that innovation is that could be triggered by the interest rate environment changing. There's the idiosyncratic nature of some of the companies hitting their actual moment of the expansion of commercialization. And in some cases, you referenced even the technologies themselves. But if I'm an advisor, that all sounds amazing. I'm looking forward to that. Don't I already have that in my? I have tech exposure. I have the Nasdaq. I have the S&P even at this point. Great. But do I have to really do anything? Aren't I just poised to benefit already?
Well, so I would argue that kind of all of the potential upside has been priced into the likes of Apple, which is, at a very high valuation, but none of the potential disruption is being anticipated. And so the issue in mega cap tech land that I think investors have is that actually there's probably like a wider degree of dispersion of potential outcomes here, but they're priced as if only the upside dispersion is what's going to play. And if they find themselves suddenly struggling to deliver the top line growth that really they have to in order for their valuations to underwrite, then they have to turn around and be like, well, we better begin to acquire these companies before they appreciate kind of beyond our ability to do so. So you could actually have, if you are an investor in the likes of Apple, you're like, oh, this is a great balance sheet and they're paying me back dividends over time. Oh no, now they're taking all their wonderful cash and paying, a huge premium for these companies that I'm not exposed to. So I have the downside of, oh, now I have the integration risk of this big company trying to integrate this other company, and I lose the capital that I was hoping they'd just pay back to me over time. Whereas if you're exposed to the disruptive names, then in the event that you get into a capital market cycle, you have the advantage of the M&A and the advantage of superior top line growth.
How much exposure of the ARKK portfolio would an advisor already have across their book if they don't own ARKK? Or an ARK fund.
What is the active share of ARKK? Do you know off the top of your head?
It's in the mid-90s.
Okay, so you have 5% exposure.
Right? Is it? That's right.
5% within your equity exposure. The way I think about kind of like the innovation tailwind here is we think that the disruptive technologies that we're focused on are going to appreciate on the order of 10x over the course of the decade. So, and that's across, the entire space. And some companies will probably enjoy a disproportionate amount of that tailwind. But if from a investing perspective, if we can just put par, then that gives us a great chance to deliver great returns to shareholders.
I've heard a couple of advisors have said, I believe that the interest rate catalyst that you referenced is going to happen, but I'm getting it in my fixed income allocation. What would your argument be back for making sure that you have that exposure to duration in the equity side of your book as well, given the upside potential of some of these names and these technologies?
I think they are different, as in saying, oh, great, I've locked in 5% because rates are going to go to 3%, gets me like net 2% in addition. I think that there's a, or at least at the technology level, there's a 40-ish% compounding that we expect over the course of the decade. Getting 5% when the market's appreciating 40, it's not that good a deal.
Yeah.
And so, innovation is by its nature volatile. This is not like a straight line up into the right thing. But I think that having an innovation exposure is both appropriate and necessary given the pace at which things are moving. There are plenty of exposures that people have in their core equity books that are potentially going to be disrupted here. So at the very least, you need to have some innovation to hedge yourself against the possibility of that disruption. So mega cap tech, maybe it'll be fine, but will your bank branches be fine? Will your freight rail be fine? Will your Boeings be fine? Gosh, it certainly doesn't look like in Boeing's case. And so having an appropriate exposure to innovation that will appreciate in case we happen to be right is a good way to protect yourself against a potential smoldering crater you have in your traditional auto exposure in your core benchmark portfolio.
Okay, so and you've touched on it a few times, but I'm gonna just hammer this point home to finish. Is that how do you respond to the point, and you look at you mentioned volatility, which of course works obviously on the upside and the downside. And I'm going to preface this by saying that, we saw in 2017 an extremely fertile time for innovation equities in an environment where rates actually went up. But how would you respond to people who say, well, innovation in the equity space was really just a figment of the Fed's imagination? The Fed put when rates were zero, sure, you could put infinite in the bottom of a fraction and innovation sounded great. That's over. It's not coming back, and innovation from an equity standpoint is not real. Here we sit. How would you respond?
Well, so for all of our positions, we don't just say, 30 years in the future, this is going to happen. We have 5-year price targets on all of the positions based upon our expectations for what's going to happen to the company. We don't pay abnormally high multiples for those 5-year price targets, as in the expectation is the company can get to this from the top line perspective, this from a gross profit perspective, which should be able to yield this much in cash flow if they were trying to optimize the cash flow. And we're not going to pay an abnormally high cash flow multiple. And we have, or we underwrite extraordinarily healthy returns on that basis. And so it does not require you to stick your interest rate to zero in order to end up there. Actually, we ascribe to these companies just trading at the market multiple, not trading at some abnormally high multiple. What's interesting about this cycle is the interest rate move was so extreme that it caused all of the innovation companies to move as if they were one. People were using even our products to short in order to provide themselves with inflation risk protection. And if you look historically, more typically what happens with our portfolios is one innovation or two innovations are working and the other three are kind of treading water. And so you end up with this kind of, hey, this is actually a real realization thing, and there's appreciation, and then there's bursts of flat, and then appreciation and bursts of flat. What I think is interesting about what's happening now is AI is moving so quickly, it's actually causing all of the technologies to kind of move at the same time. So you could get the opposite cycle where you have the combination of an interest rate change that causes people to marginally flow into innovation exposures and commercial realization happening in a more cascading one on top of the other type manner. And then it would be, kind of a stressful blow off, going upward environment, which, relative to the past 2 years would be great. And I think that, with these portfolios, with innovation portfolios, it's good to have a practice of just rebalancing. Yeah. Keep it at a target percent and kind of take profits and, and buy in on weakness. And over time, if you look, across our portfolios, that's a strategy that has done well, and I anticipate it will do well over time on a forward basis.
That's what you just described. Certainly is a pushback to the concept of spec tech. That sounds like anything but, and it's with a lot of different potential catalysts here from a macro standpoint, from an economic and rate standpoint, from a technology standpoint. Of course, obviously there's the idiosyncratic of the companies themselves. A lot of exciting things on the near horizon. We'll leave it there, and I'll leave it with one fact that at least as of the time of this recording, the S&P 500 actually has a higher allocation to this sector of technology than ARKK. So anybody who has misperceived this as a fund that it's not, obviously I think did a great job articulating what it is. Well, you can always get more information about what ARKK and any of the ARK funds are on our website at ark-funds.com. We hope that you'll not only watch this, but the other videos in this series covering all of the different ARK funds. But until that time, we appreciate you joining and watching this one. Look forward to talking to you soon, and have a great day.